what a typical conversation might look like, filtering down from the executive level through the other parts of the organization, what some of the setup might be, and then show you an example of how that could look if it was all into one place. So with that, I'm going to turn it over to Ken and let him kind of walk us through that. And Ken, please just let me know when you're ready for me to advance to the next slide.
Yeah, no, I'm ready. Go ahead. I just wanted to point out one thing on the last piece that I forgot. I don't mean to make this all about home loans and mortgage loans, because there are always unique economic drivers for every bank market. A couple of 3 years ago, 2014, there were 200 oil rigs in North Dakota, and there were people living in tents trying to build hotels and apartments and houses. 2 years later, because oil prices crashed, there were 30 operating oil rigs and a bunch of half-finished apartment buildings. Sort of the same with farmland in various places. It goes up significantly due to development, but comes down just as quickly. So you have to be careful about how you lend into those types of situations. So in this case, we're talking about acquisition, development, and construction loans. Banks well capitalized. This is an excerpt from their risk appetite statement. They're a fairly conservative bank, willing to take some risk. They want to limit their credit losses, but they'd like to improve their earnings. So they're willing to pursue some typically higher risk categories of loans, such as commercial real estate and ADC loans, but at levels under regulatory guidelines. So the concentration limit in total for CRE is 200% versus the regulatory limit of 300. For ADC loans, right now it's 70%, but they want to push that up a little bit to say 90%. So what should they be looking at? Let's move that up a little bit. They're looking at factors like data from CoStar. And if you're not familiar with CoStar, they provide just a wealth of data on commercial buildings, warehouses, and the like, rental rates per square foot, vacancy rates, absorption rates, those kinds of things. So I'm going to show you some of those. Robert, go ahead.
Sure.
So again, their strategic goal is to increase, one of their strategic goals is to increase their ADC loans from 70% of tier one capital to 90% of tier one capital. Now, there are things you need to track, not just KRIs and KPIs. There are certain activities that have to occur, such as hiring, new development lenders, retaining the existing staff, adding some portfolio managers to support lenders. So all of those become strategic initiatives. They made some assumptions. Interest rates were going to remain steady. You've probably heard this before. We're going to remain steady, not increase more than 50 basis points. Occupancy rates were tight for Class A and B office space. So the vacancy rate was low. Occupancy rates remained high. That's a favorable condition in their view. Building permits don't indicate that there's a wealth of new construction that's going to cause overbuilding conditions in the future. So based on that type of information, they've decided that that's what they're going to do. They're going to move from 70 to 90. They're going to bump up 20%. So here's some things they might want to track. Robert, go ahead. First off, got to track those strategic initiatives. And unfortunately, the way we do that today is with Excel spreadsheets or kind of clunky looking Word documents that look a little bit like this. So when we give management a progress report, this is what it looks like. And sometimes it's hard to track, what's been done and what's delayed, what's late, who's responsible. So we're going to show you a better way to do this in just a few minutes, but wanted to give you an example of what they currently look like. Robert?
This may look familiar to a few of you, but yeah, having somebody update this or sharing a spreadsheet and you get a slip of the finger and now half a column is deleted.
But just the time you spend pulling all this data together. So here's some internal factors and some external data. We're obviously going to track key performance indicators. Are we actually increasing loans? How does that compare to our policy limits? What's the trend month to month or quarter to quarter? What's our loan loss reserve data? We want to make quality loans. We want to have an adequate reserve. We want to keep track of things like loan grades. We don't want to have problems occurring in our existing portfolio as we're putting on new loans. And sometimes the factors that cause those existing loans to go bad should tell us we should stop making loans like that in the future. Policy exceptions tend to reflect a situation where we're taking on more and more risk on. So we're granting exceptions to our normal underwriting conditions in order to make the loan. So how many policy exceptions? What types? How much of the portfolio is exposed to that type of policy exception? And then let's take a look at our risk and control environment. Okay, if you look at the guidelines the regulators published, they said you can exceed that 200, 100% guideline as long as you have good underwriting and risk management controls for credit risk. So let's track our risks and controls. Let's see what that looks like over time. But we should also look at external data, because if we're just going to look internally, we're going to miss it. You know, it's like looking at the dash on your car all the time, right up until the time the Mack truck crosses the lane and hits you head on. So look at some of the commercial loan data. You know, what types of loans are your peers making? How do their positions compare to yours? What's the trend line? You know, what's the trend look like from you in comparison to your peers? Let's take a look at commercial property data of the type that we're making loans on. What's the price per square foot? What's the available space for rent? What's the net absorption rate? How much more, you know, is there a positive absorption rate, or is more space being occupied, rented, than is being vacated in a particular time period, month to month or quarter to quarter? So if you got a positive trend, that's good. That means people are moving into those office buildings. There's a demand. If it's negative, that's not a good sign. So look at general business growth data, demographic data. You know, businesses opening, people moving into the area. You know, all of those are good, favorable economic trends. There's a lot more data you can track. I just wanted to give you some quick examples. Okay.
This is a really good example of being able to pull a Federal Reserve economic database. And you mentioned CoStar as another one. Being able to pull out your FFIC call report data, do a little bit of analysis on it, of course, but some of that pure commercial loan data. All of these are information types that give you context to what your internal factors are telling you. You know, if you're doing one without the other, you're not getting that whole picture. And so a lot of the purpose of today's webinar is to show you, well, how easy can it be to pull in some of this economic data, commercial property data, and demographic data? Well, if you've already got a FRED database linked into it in a KRI format that allows you to see in comparison what these areas look like, that makes your life a lot easier. You're not having to go and grab these different areas. So that's what we'll be showing here shortly that Kim was alluding to. I'll let him kind of talk through a few more of those trends, favorable, that leads us up to seeing these in different formats. And then what does it look like if I'm looking at it all in one spot together?
Yeah, I'm not going to spend a lot of time on these, but these are just charts that showed some of that data that I was mentioning to you before. So over in that upper left-hand corner, net absorption rate, you can see it's extremely positive. So, you know, office space is being filled as quickly as it's being vacated. You know, space that's been vacated a long time is now being filled. So that indicates there's a demand for office space. So if you're considering making the next construction loan for an office building, you got to think about how long that trend is going to continue, because it takes, you know, a good year or so to get one of these 3-story office buildings up and ready to be occupied. But all of these are favorable trends. Vacancy rates going down, absorption rate is skyrocketing, the rental rates moving up, so plenty of income to service the debt. Okay. All right. These are the kinds of things you'd want to track on a regular basis to see, you know, is my strategic direction that I set out, is that still a valid direction to go? Does the economic data indicate to me that I'm okay, that I'm not taking on too much risk, that the environment is favorable to the type of strategy that I'm deploying? You can see here, this is what I mean by putting a number of different trend lines on the same chart. I can see where I am current period, that starts on the left-hand side at the bottom. You can see how we grew the portfolio, and then we started to back off a little bit, and I'll show you why in just a second. You can see what the regulatory limit is, that straight line. So we went way above the regulatory limit. You can see what our risk appetite tolerance is. That's that sort of staggered line at the bottom. So we moved our risk appetite closer to the regulatory limit. But you can see our peers were sort of, they were not growing as quickly as we were, and they started pulling out of that market all about the same time we did. So that sort of validates our decision to start moving away from that market. Okay, Robert?
Yeah.
And this one I think is important. You know, total risk rating, that big red line. pulls in things like the risk and control rating limit, that sort of dark line at the bottom. That's where we wanted to be, but we weren't there. Our risk rating, our controls were not as effective. So what that told me was, if I'm a director, we're loosening up our controls, our underwriting standards, that green line over here on the left, just above the red line. We're loosening up our underwriting controls, or we have weaknesses in controls, and we're taking on too much risk. So we either loosen controls to take the risk, or we took the risk and we're not managing it very well. So maybe we need to back up a little bit. Let's improve our control scores. So you see those go down, and you see the volume of loans start to come back down. So we got too risky. It's pretty easy for me to see as a director why. You know, we're starting to blow up here. My financial risk rating is skyrocketing. My control rating is weak. This is just not a good place to be. So let's pull back a little bit. So these are the kinds of indicators you want to track, and this is what they will start to tell you. It's just a little difficult doing this always in Excel spreadsheets. So we're gonna show you a little better way here in just a second.